Good morning, good morning, good morning. Hi, everybody. It's Boris Schlossberg. Welcome to the first real full week of trading the fall season, Sept 12 to Sept 16. Sorry, I'm still trying to figure out the week. Nice to see everybody. We're going to start off with me sharing my screen here because I want to share the calendar. Hopefully, everybody is going to be able to see my screen. So let's talk about what's going on today, and let's talk about what's going on this week. This week is really all about CPI week, and it's U.S. has both consumer price index and PPI data. As a matter of fact, let's just kind of clean up this calendar to just look at the most important data sets first and foremost. Okay, so we'll just apply the filter, and you see basically that we have the GDP data today out of UK, mildly weaker. But the real big story is going to be the CPI data out of the US, the PPI data out of the US, and then end of the week, it's really going to be just a smattering of Australian data, retail sales out of the US, and U of Michigan data. It's very, very US centric chart, or very US centric echo calendar this week. Not really much coming out of Europe or Asia Pac that is really of strong interest. But what I was going to say is the market right now is anticipating a generally benign CPI data, right? You're seeing lots of risk flows on in equities. Euro is a little bit stronger. We'll go through the currencies as well. But the general assumption here is we've had a lot of data that has fallen off a cliff. I think, let me just go see if I can find my own Twitter. Let me just find myself here. Just 1 second. Where are we? Okay, here's FX flow. Let me see my own tweets. I just tweeted this out, so you can actually see it. Here it is. Rents have declined. Used car prices, this is all US data, obviously. US car prices have really fallen hard, and gasoline prices have fallen hard. So the conventional wisdom basically is that data is going to start to finally go down, which is really huge. And that's going to be very, very important for the market. What's really going to be interesting, I think, is not so much that if the data is down, but just how much. As always, what really matters in the market isn't the absolute number, but the number relative to expectation. So expectation right now is for actually a slightly negative month over month, 0.1 basis points on the CPI. The problem, or I think the risk in the market, is if it doesn't happen, if we just sort of flat, or if actually we have, I have all my well, actually I can't kill all my alerts, so you guys just have to bear with my alerts, because I'll explain to you how I trade and do all my alerts in just a bit. But what I was going to say is, the thing that you need to kind of appreciate is that the risk here could be to the upside. Everybody's already positioned for a soft CPI number. If the inflation remains stickier than we imagine, that's going to be a real big problem for the market. So we kind of have to really, really be aware that there is some negative shock risk possible. Now, if it does confirm, actually, and there's two ways it can go. If we actually have better than expected declines in CPI, that could be massively positive, because at this point, the market is still very short risk assets, still very negative equities, and still very long the dollar. So if you get a really, really sharp CPI, maybe the dollar gets a little bit of a decline. Although, having said this, I got to tell you, it doesn't matter what the inflation number is. I mean, there's only bad news on the inflation number that can happen to us, because even if the inflation is like minus 0.5%, just a sort of significant shrinkage in price levels, it's not going to matter, because the Fed is gung-ho on raising rates 75 basis points. The Fed now is sort of, I think, in this very interesting position where it decided it's going to raise rates hard early so that it can stop early. The Fed, to understand what's going on with the U.S. Monetary policy, you have to understand that under no circumstances could the Fed really raise rates above 4% because U.S. debt is so large. The servicing of the U.S. debt at 4 to 5% interest rates will be so expensive, and the Fed will have to monetize so much that it could create much worse problems. Because remember, we're coming off of very, very low interest rate financing, right? If you go from 2% to 4%, your debt service costs, forget about just paying off the debt, your debt service costs double. So you go to like $500 billion in interest rate payments. That's extraordinarily expensive, even with government money, because you still got to print that money. And so the Fed is, I think, very, very focused on making sure that what happens is they kill inflation early, they raise rates to like 3.5%, and just keep them there at that level so they can finance government deficits for the next several years. I think it's an intelligent strategy given their choices, but you have to be mindful of the fact that it doesn't really matter what the economic data is. The Fed is going to really go hard. What's bad is if the data is much worse, and then the Fed's idea that, okay, we're going to cap it at 3.5%, 4%, comes into trouble. That's where they lose control of monetary policy, and that's what you need to be really, really aware of, right? So I wanted to just sort of let you guys know about that, because that's an issue that everybody's going to be worried about as we go forward. Okay, so the next order of business, obviously after CPI, we're going to have U.S. retail sales. That's also an interesting subset, because the question is, we're having very, very strong labor conditions in the U.S. market. One of the interesting things, by the way, that I read that I think is fascinating is everybody's talking about the fact that U.S. labor conditions are tight because of demographic reasons. We literally have the smallest population coming into the labor force in a very long time, and just simply the fact that there's just not enough working age people, and therefore it's not necessarily even such a huge demand from businesses. It's just there's an incredible lack of supply from labor. So you have this very, very tight labor that's creating definitely better income structures for the labor force. And it's a question whether it's going to translate into a little bit better core retail sales. Going to be watching that. University of Michigan Consumer Sentiment Survey, which may pop itself back up towards the 60s. Those issues will be of some interest. So really, as I said, it's primarily a U.S. Data-driven week. There's two pieces of data that we have on the calendar. We have the New Zealand GDP, which is looked to be rebounded to about 1%, and Australian employment change, which also looks to be positive from last month's very, very negative print. Australia hiked rates pretty strongly. Let's take a look actually now at all the majors to just kind of see where things stand. You know what? Let me pull up a different chart here. Let's do this. Go to the FX majors chart. Look at the hourly charts here, and we can start with the euro dollar, which continues to just be a very, very strong risk on trade. The euro dollar is really, by the way, mirroring the German. The German is up 1%, euros is up 1%. If we look back at like kind of a daily chart, we certainly seem to have found the bottom under the 99 level, right? The big question though is in the euros 75 basis points hike, certainly since the ECB meeting last week, certainly has given it some potential oomph, but the pair really comes up under very, very strong resist here at the 103 level, right? You can see these, by the way, this is a proprietary indicator that we have at BK called my bounce indicator. We use this literally on the 1 minute chart, and we can use it on the 1 month chart. It's super, super good at not only giving us points of momentum, but pivot points at where we think there's going to be serious, resistance points. So this is a very, very big resistance point here at this 102,760 level. We get up there, it's very likely it's going to retrace a little bit. The big question, though, is have we made an intermediate term bottom? It looks to be right now, yes. I mean, at very minimum, you have to just kind of operate on the assumption that, okay, we've made a bottom, we may retest the bottom, but right now you have to operate that the euro is pretty much 99 bottom going forward until proven otherwise, and pretty much trade from the long side up to this resistance point. Once you get to the resistance point, we may have some correction, and then you're sort of like, trapped in a no man's land for a little bit. So yeah, euro looking near term as a positive buy all the way up towards the 103s as a trade. Cable also really coming off very strong oversold conditions. Got quite a lot of ways to go to even find a big resistance point. Right now, it's basically trading at. Let me get we are on monthly reference points. That's right. So this is just a monthly range. It's a very tight range. So we made fresh session lows in this month. Big spike, by the way. That's relatively bullish on the euro. This kind of a V-shaped spike. For now, the near-term resistance point is going to be this 1800 level. But overall, it really looks like as we're starting the week, we're certainly coming back with very positive risk-on flows, and possibly, especially if we get a weak CPI tomorrow, even though the Fed is going to hike, the weak CPI is going to communicate to the market, okay, the Fed has breathing room. It's going to hike its rates, but it's not going to go beyond the 3.5% level. So it's going to pretty much hit a terminal rate very soon. That's all positive risk flows, and it's going to do well. You see, by the way, also dollar yen really starting to correct. This is the single most bullish chart in a long time, and what that means, you'd probably be surprised for me to hear, is that it's also the most vulnerable to the biggest sell-off, right? The harder they rise, the harder they fall. And we're at 145, clearly breaking this down. I think the thing is that if we're sort of making a bet, right, a binary bet, I think we hit 140 before we hit 145. So if you're trading dollar yen, position accordingly. I think you could sell the momentum here to the downside, at least for the 140 test, as the corrective phase needs to have a lot more correction before it finds some sort of a bottom. Look at these sort of corrective phases in this general rally. Obviously we have a small corrective phase here, which was 25 to 400, basically 400. 4 big yen, 400 four handles, 29, kind of down to 300 candles. Then here it was a 31 to 26, 500 points. 5 big figures. Here it was 39 to 39 big figures. So if you sort of look at it, the average corrective phases have been between 5 and 9 big figures, and we're really only like 44 2 big figures off the corrective phase. So it makes imminent sense that we can have at least two more, basically get out to 5 big figures, probably most likely 6 or 7 big figures down to the 38 level before we find full support. So to me, if you like to trade turns, dollar yen is one of the strongest turns we have in the trade. Euro dollar, on the other hand, euro yen, of course, on the other hand, is actually positive. It's getting momentum flows from the positive euro flows. So not quite as short here. However, I think the negative yen moves are going to move on the euro. The yen is going to the decline in dollar yen is going to outweigh the rise in euro dollar. So this kind of a spike around the 146 certainly gives us a chance. I would wait for a red candle in the dailies, but if you get a red candle like this, I would sell this all the way down to the 140s as we go down. So FX is bifurcated, but it's clear, I think, that you have a dollar corrective move pretty much across the field. Let's take a look at the COM dollars, because that's actually interesting. So the COM dollars, to me, a lot of people are making a big bet that the COM dollars are going to be the strongest in this dollar reversal rally. It makes a lot of sense because commodities are still very strongly bid. All those COM dollar economies are doing much better than the European economies. So it makes imminent sense to, if you're going to express yourself on being short dollar, you kind of want to be shorted against the commodity dollar currencies. So dollar CAD obviously probing the 130, already broke the 130 level, which means we're very likely now to come down to this 120 to 128.50 level. More importantly, Aussie dollar, which is coming off the lows here, that's a trade that a lot of people are getting bullish on because again, the commodity flex, the comeback of China probably off a lot of the COVID lockdowns, and the possible extension here. So we have a double bottom at the 67. We don't really have resist until about 69.50. So at least another 100 points to the upside, and probably, realistically speaking, 70, 100 would be the near-term resist. So Aussie dollar looks very, very strong on a pure basis, and then the Kiwi dollar really looks very good. We made a lower low, but now we're just very, very bullishly held. Kiwi dollar also just went off, released full, no more COVID restrictions at all, and the New Zealand economy should definitely help growth, which we've already seen growth come back a little bit better. So that should be a move back up towards the 6,200 level in the Kiwi dollar. All of that sort of suggests a couple of interesting plays. I think if you want to trade crosses and you believe that the COM dollars are the better trade, then what you're really looking for here is, although we're having obviously big moves in the euro dollar against the COM dollars, I still think that some of these trades where you are short, especially like EURCAD to the short side, or more importantly, let me just pull up euro. The trade that I'm interested in is Euro Aussie, and which obviously looks weakest, right? So here we are, we popped it at the 149, kind of weakening over here. I think especially if you're coming into the Australian employment data feeling that it's going to be relatively good, this is a very decent cross trade against the 49 stop. So if the Australian data is bad, it's going to blow through the stop. But if it's good, you have a reasonable chance here for us to drift back down to the 4,600 level on Australian relative strength. Okay, so that's the currency market. Let's take a look at gold, and let's take a look at oil as well. So gold has been a sleeper. Gold has been a very, very big sleeper trade, but a lot of macro research that I'm reading is long-term getting very, very bullish on gold. But more importantly, on the short term, what I noticed in my September research is that we have a very clear, very defined double bottom. So I think one of the most interesting technical trades here is just gold long against this maybe where we lost 1680, 1670 stop, right? You just if you think there's going to be a small spike down, but generally you shouldn't come near the stop. If this is a true momentum force in gold on a technical side, this looks very, very good as a potential move all the way up to 1760, 1780. It's probably one of the strongest technical trades we have in the books. Oil is just consolidation. Oil had a massive reversal off the highs. It's unclear, what we're doing with oil on a fundamental basis, because clearly they're still pumping a lot of oil out of the Middle East, and U.S. is doing a lot of SDR. But I think we're certainly closer to a near-term bottom in terms of the move here. 80 seems to be pretty decent support, but it's going to be really range bound. It's probably going to be an 80-90 trade for quite a while. So it looks least interesting as far as a tradable instrument. And then lastly, looking at crypto here, crypto looks also very interesting because it's kind of a revival of risk a little bit for the last couple of days, especially this very, very large bullish candle is a pretty decent signal that this 18,000, 19,000, 20,000 support level holding for now. And again, you're trading, I think, Bitcoin the same way you're trading gold. You're just going to assume that this support is what you want to trade against. And if we do have a turn to the upside here, that's the legitimate turn, trade back up. Of course, crypto is really getting lifted up by expectations of the fork in Ethereum, that Ethereum is going to be a lot more flexible, a lot faster, a lot cheaper to do on a proof of stake concept than a proof of work concept. We'll have to see. As Ethereum is trading well, but very, very tight range. The really big story, if Ethereum takes out 2,000 and everybody suddenly it's back in the news and crypto is back in the news, that's going to be the big runner. So watch that. That's, if Ethereum takes out 2,000, it's going to be positive across the board for all crypto, but especially for, of course, the leaders with Ethereum and Bitcoin. So that's how the calendar shapes up this week. I think the strongest sort of intermediate term trades right now on a technical basis is long gold, short dollar yen, and both ETH and Bitcoin against their near-term lows, but especially Bitcoin on just a cleaner technical basis here against the 18,000 lows. Both look quite good as trades. In the FX land, the Euro Aussie trade to the short side, and it'll be interesting. We'll come back. I guess we'll do another session midweek on Wednesday. We'll see how the data has shifted. We'll see how the prices have shifted. But it'll be interesting to see where things stand at that point. So that's pretty much it, guys. Hopefully you guys enjoy the week. The week should be great. We're starting off on a good note, on a positive risk factor. Let me see if I see any questions. I don't see any questions here from anybody. If you have any, I'll wait for a second. Feel free to give me a question, and I'll be happy to answer it for you guys. No, everybody's good. So those are the trades for the week for you guys. Hopefully you guys enjoy it. And hopefully I will see everybody here in BK. We're trading really, really well. If you guys want to see, I already traded quite a lot this morning. Longs in the Dow, shorts in the Dow. I would have had more shorts in the Dow, but I was with you guys today, so I couldn't take this. We scalp all day long. And if you want to live trade and day trade with me, please join us at bkforex.com. All you need to do is actually top off your AUDUSD account. Ask your AUDUSD representative how much money you need to deposit. But if you just simply deposit a certain amount of money, you actually get to trade with me for free. If you deposit $10,000 US, you get to trade for me for a whole year, which is very most people have at least a $10,000 account. So if you drop that amount of money, you might as well use the full benefit of AUDUSD and trade live with me all year long and just bank away, which is what we've been doing all day long. As you can see, I trade live. All of my trades are, shown live, so you can follow me live, and then I trade live in a room, in a Zoom room every single day as well. So hopefully I'll see you guys in the room with me, and we'll trade together. That's it, guys. Everybody have a wonderful day. I will see everybody on Wednesday. Take care.